Japan's bond market in full-blown meltdown as the Japanese bond market seems to be completely imploding with rates skyrocketing over 30 basis points today alone. The risk of bond market contagion is soaring. We're seeing concerning moves in the US Treasury market. The dollar is dumping and stocks all around the world are selling off. Let's dive into the market chaos. So there is a lot going on. No other word to describe what's going on in Japan than a full-blown meltdown. The 30-year JGB yield is up by more than 30 basis points today alone. We're going to start with Japan, but arguably way more important is what's going on here in the US with the dollar, potential global monetary reordering that I've been talking about. We'll look at that. Arguably, what is going on in the US is much more important than what is going on in Japan, but everyone's talking about Japan, so let's take a look at that. This is dragging US Treasury rates higher, some significant moves in the US Treasury market we'll take a look at towards the end. But to start with Japan, we're going to see long end rates moving much higher very, very quickly at a much faster rate than short-term rates. This is known as a yield curve steepening, where the gap between long rates and short rates is growing wider. Now, it's called a bear steepener because remember that the yield is inverse to the value of the bond. So when you see yields going vertical, the other way of saying that is the bond is just getting dumped to oblivion. Now, the blue line shows that difference, that spread between long end rates and short-term rates. And we can see just a couple days ago, it was 227 basis points. Well, it is at 270 basis points. So we are seeing a brutal bear steepener going on in Japan. And again, the move is concentrated at the long end of the yield curve. Now, here's the nuance that very few will actually tell you. Despite the dramatic moves going on in Japan, arguably, there's way more of a risk for the U.S. and for the U.S. Treasury market than there is for Japan. Let's take a look why. So if you look at the issuance schedule by tenor, by duration, the vast majority of their debt is being issued in short-term instruments under 5 years and under. So the notes and the bill section. Well, those rates are moving higher, as we can see here, the 5-year, for example, moving higher, but at a much slower pace than the long end rates. Well, the long end gets very, very little issuance, much like, of course, in the US. So when you have the long end going up by 30 basis points in a single day, if you're not issuing your debt there, doesn't necessarily matter all that much. Now, there is some nuance, of course. Insurance companies do hold a lot of this debt. And again, when rates are moving higher, the value of the bond is moving lower. The collateral value is moving lower. This is what blew up the regional banks here in 2023. 3 of the 4 largest bank failures in U.S. history occurred in the past 5 years in 2023. This is what did it. Long end rates, the banks had loaded up at 50 basis points, 1% interest rates, and then we jacked up interest rates and the value of those bonds fell. There was a run on deposits. The banks, if they were to sell this collateral in the form of long-term U.S. Treasuries, they would not be able to come up with nearly as much money as they thought they would. Now, if you hold to maturity, of course, it's worth par value. But when you have a run on deposits, you're not able to do that. So could you see some issues like that in the banks or maybe an insurance company? Absolutely. But what really matters is the debt to GDP. So everyone knows debt to GDP for Japan, 240%. But arguably way more important is who owns that debt. Within Japan, that debt is owned 88%. Foreigners only own 12% of the outstanding Japanese government debt. That is incredibly important. And not only is it the external debt very, very low at 12%, not only that, but the Bank of Japan owns half of the bond market. So when there's interest, it basically just gets recycled. So this is incredibly important. Arguably, Japan is not necessarily at an imminent risk of collapse. You could see stress, of course, in the banks, maybe insurance companies, but the vast majority of the debt is held by the Bank of Japan, and the external debt is incredibly low. So again, most of the debt being issued at the short end means that long end rates moving dramatically higher doesn't matter nearly as much. And once you look at who actually holds the debt, you can see that, again, the Bank of Japan owns 50%. Now, here is a candlestick chart for the 30-year JGB yield. It is incredible. No other word than a full-blown meltdown. We haven't seen this since the Liz Truss moment in Great Britain or early April here in the U.S. And again, what's going on in the U.S. is arguably way more important. We'll get to that in a second. But the finance minister did make this interesting comment basically after long end rates had just completely melted up. He said markets need to calm down. And I thought that that was funny. The bond market would probably calm down if you got a little bit less dovish fiscal policy out of Takaichi, who just about a day or two ago announced a cut to the sales tax on food, also calling for a snap election and dissolving the lower house over there in Japan. So if we take a look at their yield curve, this is going to show that repatriation risk that is arguably more important. So remember, Japan on an aggregate net basis, they overproduce. They consume more, produce more value, than they consume. So what this means is that wealth savings are generally flowing into the country, whether it be the individual level, whether it be the firms, or whether it be the government of Japan. On an overall aggregate basis, they produce more value than they consume. They accumulate savings. Well, Japan had very low rates, negative interest rates for a long time. And so those savings couldn't go into domestic bonds. Where did they go? Well, they got sold. The yen got sold to buy the dollar, putting downward pressure on the yen, upward pressure on the dollar, then went into US Treasury. So as rates move higher, again, some of that money might want to start to come back home. And there's an equilibrium that could be found with these higher rates. And again, that spells issue for the US Treasury market, not for the Japanese bond market necessarily. So here we're going to look at two different exchange rates, yen, euro, and yen, dollar, because more intuitive to think of it this way. Obviously, the yen has been weakening, and obviously bonds, especially at the long end of the yield curve, have been melting down, selling off quite sharply. Remember, the inverse is the value of the bond. So that would be incredibly concerning. However, we're not seeing the equity market sell off. Now, over the past couple of days, you are seeing a bit of a pullback in the Nikkei, their major stock index, but you are not seeing a huge sort of capital flight, emerging market sort of phenomenon like you are actually seeing in the US, which we'll get to here in a second. But looking at interest rate differentials versus the strength of the currency, this diverged back in early April with Liberation Day chaos. You had the US 10-year yield moving sharply higher. The spread over the Japanese 10-year yield, you were getting much more yield in the US. However, the dollar was selling off. You don't want to generally see that. Not a good sign. However, what we've been seeing recently is the exact opposite, which is the dollar has been strengthening despite the fact that our rates are moving lower relative to Japan. You are actually getting less and less premium to buy US Treasuries over JGBs, but yet the dollar's been strengthening. But zoom in a bit to over the past couple days, we're seeing a bid into the yen. And by the way, we did call out a yen long in the Discord here. That is working quite well. But you're seeing the US 10-year yield moving lower versus Japan, and to be expected, which is the dollar moving lower relative to the yen. A lot going on with the dollar. We'll get to that in a second. Here's the stock 600 gapping down yet again today. This is kind of overall European average. This gap down significantly yet again today. Here's the DAX, the major index for Germany. Another brutal gap down over there on the DAX. And here's the CAC, which is France. Again, another brutal gap down on the CAC. Looks like it was trying to recover at the end. It's important to point out, though, that going back to early 2025, the CAC, even adjusting for the currency, the euro dollar movements in euro dollar, even adjusting for that and denominating both in dollars, the CAC is up by 7% and the DAX is up by even more. So we have seen outperformance over the S&P 500 in the DAX by about 20%. So looking at US Treasuries, this is arguably way more important than what's going on in Japan. Japan obviously causing some of this, possibly some repatriation going on, possibly maybe a bit of yen carry trade starting to unwind. If individuals in that trade are worried about a yen intervention, which seems increasingly likely, you might be seeing a bit of folks unwind a carry trade they might have put on. Here we're looking at the 2-year futures, the 5-year bond futures, the 10-year bond futures, and the 30-year bond futures. Here is a great illustration on duration. Obviously, the long end of the yield curve is going to move much more than short-term bills, the value of the bond, which is what we're looking at with the futures, not the yield. The yield would be inverse to this. We have U.S. Treasury yield sharply higher today. We have a bear steepener, the pink line showing that the spread is widening by about 7-8 basis points. And again, a couple important spreads to point out. Pink shows the difference between our 30-year yield and our 2-year yield yield. The teal line here shows the difference between the 10-year and the Fed funds. Really important to point out that, again, your car loan, your mortgage rate, your small business loan is not priced off the Fed funds rate. What matters is the 10-year. Well, the 10-year, long end of the yield curve, independent from the Fed. And that is where we are seeing the most pronounced selling today in the US Treasury market is in duration, in the 10-year and the 20-year and the 30-year. So again, the higher the 10-year moves relative to the Fed funds, the less it matters what the Fed is actually doing. Because again, what you need is priced off the 10-year. The 10-year is independent from the Fed, is going to function much more based on fiscal concern, term premium, that sort of thing, as well as growth and inflation concerns. By the way, if we're going to go into a run it hot, high growth environment, rates are going to move up. Now, taking a look at the long end of the yield curve for Germany, France, Great Britain, Japan, and the US, again, Japan just melting up, but arguably way more important that we're seeing US rates moving higher as well. The 30-year yield here in the US is back at 490, very close to that critical 5% level where it has found a bid before. But if you look at France, Germany, Great Britain, their long end has been underperforming, has been very, very weak for the past couple years. But we are actually not seeing their rates, their long end rates move higher. We're seeing it in the US, which gets to the monetary reordering that we are starting to see early signs of. And I really want to get to this because it's critical what is going on in the US. We have the dollar down, we have stocks down, and we have bonds down. That is textbook capital flight. That is textbook capital flight that you generally see out of an emerging market. And again, going back to Japan, you're not seeing it there. Their stock market is actually ripping higher. So you're not seeing it in Japan, but you are seeing it in the US. Here's one way to think about it. Here is dollar, euro, and then again, that interest rate differential, or the difference between our 10-year yield and the European average 10-year yield. And we can see that spread is widening, meaning that you are getting more and more interest in US Treasuries. But despite that, we actually have the dollar weakening versus the euro. Now, that is not a divergence that you want to see. Here's the S&P 500 gapping down significantly. Obviously, yesterday was closed for the cash market. We do have the S&P 500 down by about 1.2%. We have the NASDAQ down by 1.2%. IWM down by just half of 1%. Equal weight S&P down by 0.8%. But what is more important is what is going on with the dollar. So the dollar is down by 0.6%, was as much as 0.7, 0.8% earlier today, which is a pretty significant move for the DXY, of course, the reserve currency. A couple important things that arguably this is way more important than what's going on in Japan. We are seeing a breakdown of the traditional dynamic. So on a couple of levels, number one, when there's geopolitical tension and a risk-off sentiment, generally the dollar would get bid. It was the safe haven. Well, that is reversing. As I covered, bonds are down, stocks are down, and the dollar's down, which makes you wonder, well, what is up? Well, what's up is the euro, the Swiss franc, the yen, ever so slightly, and gold. Now, I started to notice this back in early 2025, way before all the de-dollarization was on CNBC, of course, with April and the Liberation Day. I would wake up early in the morning and see the dollar would be down, stocks would be down, and bonds would be down. Now, not to this degree, just, 10, 20 basis points, but I started to notice it even before Liberation Day. That is rotation out. I would look at what is actually up. If all three of our major asset classes are down, well, what's up? It was, again, the yen, the euro, the Swiss franc, and gold. Now, that is an end to the reserve currency status. Now, it's not going to happen overnight, of course. It's going to take 10, 15, 20 years. But we already know the U.S. Treasuries are falling below gold in terms of foreign FX holdings. This is going to take a long time to actually play out. This kind of thing does not happen overnight. But these sort of catalysts are really important. So we had a risk-off geopolitical escalation. Dollar didn't get bid. We also had the balance of trade come in at a low in terms of the deficit going back to 2009 and the third lowest level going back to 2001. And yet the dollar didn't squeeze. Remember, the other side of the balance of trade is the number of dollars that we're sending out to the rest of the world. This is Triffin's dilemma. You must run ever larger trade deficits to fulfill your obligation as a reserve currency issuer. Well, we couldn't do that if we're balancing trade and the trade deficit is shrinking. So the supply of dollars going out to the rest of the world, which, by the way, is structurally short US dollars, is shrinking. You would expect the dollar to rip higher in a bit of a short squeeze sort of phenomenon. We didn't see that. So Really important to point out the divergences that we're seeing with traditional dynamics. So again, the dollar's not getting bid in the sort of situations you would expect it to get bid. The safe havens are the Swiss franc, which is approaching the 2011 low. That was the PIGS European debt crisis. The Swiss franc, by the way, one of the only currencies to actually strengthen versus the dollar. Here we'll look on a long-term time frame. You can see that generally the dollar weakens versus the Swiss franc. That is continuing. We are approaching this kind of the low end of this range, but the Swissy has been a safe haven. Here is the yen or dollar yen, and we have been seeing a bit of a bid into the yen. Maybe folks starting to get concerned about a yen intervention, where of course the Bank of Japan Ministry of Finance sell dollar-denominated assets to buy the yen. Obviously, not good for U.S. Treasuries. And I want to cover commodities. So oil's moving higher, possibly on geopolitical concerns, possibly on fundamentals. There are some developments with short-term supply when it comes to the Permian basin that I saw earlier today. Here's the Goldman Sachs Commodity Index, up by about 1.3%, and gold is ripping higher. Once again, gold is up by 3.3%. Very, very strong day. Again, if you don't buy US stocks, if you're selling US stocks, if you're selling US Treasuries, and you're selling the dollar, what are you buying? Well, it's gold, euro, yen, and the Swiss franc. This is really, really critical for people to understand. Now, taking a look, just going back to the 18th, silver is up by 6.5%. Gold is up by 3.6%. Pretty major move for a large asset class like gold to see that happening. And copper is actually getting sold a bit, maybe on lower growth expectations due to trade tensions that are developing. So S&P 500 gapping down, not really getting too much of a bid into close here. We do have volatility up, Bitcoin down, trading off at like a risk on asset, trading off of S&P 500 or NASDAQ. Gold just gapping up and going vertical. Again, the bear steepening in the yield curve, 2-year, 10-year, and 30-year. The 30-year was up earlier today by as much as 7 or 8 basis points. So again, remember that repatriation risk. Japan, on an aggregate basis, owns a ton of US Treasuries because, again, they couldn't buy their own sovereign debt because there was no yield there. So they bought our debt. Well, again, higher rates, eventually it's going to get to a point where the Japanese go, you know what? I put my money in US Treasuries, but now we actually have yield. So I'm going to bring that money back home. That is very bad. That's why you get global bond market contagion. That's why higher rates in one country can lead to higher rates everywhere. The markets nowadays, economies nowadays, everything is interconnected. So really important to understand all of this. But again, arguably, the bigger issue is not in Japan. Very low external debt to GDP, very small amount of issuance in the long end of the yield curve. Arguably, the risk of higher rates in Japan, like we're seeing here, the risk is more to a repatriation event or potentially a yen carry trade unwind if you get an intervention in the yen. Maybe if the Bank of Japan hikes 25 basis points here at the next meeting, that sort of thing that is unexpected by the market, a dramatic yen strengthening, maybe you get a bit of yen carry trade unwind. But again, it's much more important what is going on in the US, what is going on with the dollar. You have the dollar down, you have stocks down, and you have bonds down. What is up? It is not the dollar, it's gold. It's the Swiss franc, it's the euro, and to some degree, it's the yen. So that is arguably what is way more important. Now, if this continues like it did in early April, you're talking about an early stage of a bounce of payments crisis, which is a whole other ballgame that maybe I could do a video on if people are interested. But anyways, hopefully that was helpful. A lot of volatility right now. Continue to update you as I see more developments. Hopefully it was helpful. I'll catch you on the next one.